So, check this out. A company smashes its earnings, you'd think Wall Street would be throwing a party, right? Well, not so fast. With the Bank of Nova Scotia, we've got this really interesting puzzle. They had a fantastic quarter, but one analyst is basically saying, hold on, this stock is way too expensive. So, what's the deal? Let's dive in and figure it out.
Okay, so first up, let's just look at the headline numbers. And honestly, on the surface, everything looks amazing. It really seems like Scotiabank is firing on all cylinders. A 23% jump in adjusted earnings per share year over year. I mean, for a massive, established bank like this, that is a huge number. You just don't see that kind of growth very often. It's the kind of thing that makes everyone sit up and take notice.
And this wasn't just some fluke. The growth was coming from really solid places. You've got wealth management up a very healthy 18%. And then, get this, their global markets division was up 50%. 50! So yeah, on paper, this looks like a slam dunk.
But here's where things get tricky. Even with those incredible numbers, the analyst we're looking at sees a big red flag. The stock's trading up around $96, but their estimate of what it's actually worth, what they call the fair value, is way down at $78. That is a massive disconnect, and we've got to figure out why.
And this chart, wow, it just lays it all out there, doesn't it? You can see the stock price way up here, deep in what the analyst is calling overvalued territory. And then there's their fair value estimate, much, much lower. This visual really captures the whole puzzle perfectly.
So this leads us to the big question, right? How can a bank be performing this well, and yet an analyst is pumping the brakes? What is it they see that maybe the broader market is overlooking?
All right, to really get to the bottom of this, we need to talk about what makes Scotiabank, well, Scotiabank. See, it's not your typical Canadian bank, and that unique identity is absolutely central to this whole valuation mystery.
They don't call it Canada's most international bank for nothing. Just look at this breakdown. Yeah, about half its revenue comes from Canada, but more than 40% comes from outside the country, a huge chunk of that from Latin America. That's what really makes it different from its peers.
And that huge international business is now right at the center of a big change in strategy. There's a new CEO in charge, and they're pushing this North America corridor idea, basically zeroing in on Canada, the US, and Mexico. Keep that in mind because it's going to be super important for where the bank is headed.
Okay, so how does this whole international bank thing connect back to the stock price? Well, to get inside the analyst's head, we have to talk about one of their most important tools, a concept they call the economic moat.
And it's a great name because it's exactly what it sounds like. Think of a castle with a big, wide moat around it. That's the idea. It's a sustainable competitive advantage that protects a company's profits from rivals. It could be a super strong brand, or maybe it's just a huge pain for customers to switch to a competitor. The bigger the moat, the better protected the company is long-term.
And boom, here it is. This is the heart of the analyst's entire argument. When they look at Scotiabank's different parts, they see that the Canadian banking, the wealth management, the global markets, all of those have a moat. They're protected. But that massive international business, the thing that makes them stand out, the analyst says it has no moat. None. Zero.
There's a quote from the report that just hits the nail on the head. It says that the international side has often been more of a drag than a boost. And that's the key. Without that moat, without that protection, this huge slice of their business is just riskier, and its profits are way more unpredictable. This is the fundamental reason for all the caution. So you've got this kind of split personality, right? Super strong and protected here at home, but kind of vulnerable out in the world. And that leads to two totally different stories about where this bank is going. You've got the bull case, and you've got the bear case.
Let's start with the bulls, the optimists. They're looking at that new CEO's North America strategy and saying, yes, that's exactly what they need to do to get better returns. They also point out that Scotiabank actually has less exposure to the Canadian housing market than its peers, which, could be a pretty smart place to be right now.
But then you have the bears, and they are looking straight at that no-moat international business and all the risks that come with it. They're saying, look at the track record. It's been a drag on performance. Plus, they're worried about new things, like the risk of trade tariffs hitting Mexico, and just how expensive it's going to be to fight for customers in really competitive markets.
And when you put Scotiabank side by side with a competitor like Royal Bank, it all becomes crystal clear. See, the analyst gives Royal Bank a wide moat. It's a fortress. But Scotiabank only gets a narrow one, and it's all because that international business is dragging the whole score down.
This one difference in their moat rating really changes everything.
Okay, let's bring it all home. We've talked about the great quarter, the international risk, the moat, the bulls, the bears. How does all of that get boiled down into one single number?
Well, it comes down to some pretty cautious assumptions in the analyst model. Because of that international risk, they're basically adding a risk penalty, what's called a higher cost of equity. They're also forecasting that the bank probably won't hit its own internal efficiency goals and that credit costs might stay high because of all the economic uncertainty out there.
So you plug all of that into the spreadsheet, run the numbers, and this is where you land. 78 Canadian dollars. That's their fair value estimate. And that, my friends, brings us full circle. That $78 number is the whole reason for the overvalued rating. Yes, the last quarter was fantastic, but in this analyst's view, the current stock price just isn't factoring in those long-term risks that are lurking in the international side of the business.
So, at the end of the day, the big takeaway here isn't just a price target. It's really a huge question about the future. Is this new North America corridor strategy going to be the thing that finally fixes these old problems? Can it widen the bank's moat and prove the doubters wrong? I mean, that is the multi-billion-dollar question, and the answer will decide whether today's stock price is justified or not.